Welcome back, guys. In this video, we'll talk about how to start investing in 2024 as a teenager or someone in your 20s. I'm sure you have heard about investing from a lot of places. So, to make your investing journey simple, I'll break down investing into 8 crucial steps in this video. I know investing seems very lucrative as well as complex from outside world. Here is what we are going to cover in this video so your journey is more simple and more smooth. Furnishing your psychology and understanding your own risk appetite because every individual is different, so you have to understand yourself deeply to become a better investor. Psychology is the most important part to start investing. Now the question arises, what investing really is? Well, in layman's term, investing is just an investor purchasing an asset to get returns or profit via appreciation of that asset. It's very basic, a lot goes behind the scene. To understand investing deeply, we have to understand the explanation of Benjamin Graham, the father of. He says an investment is based on thorough analysis and abiding principles of safety as well as getting adequate return. Thorough analysis refers to understanding the underlying business of the company and understanding the fundamentals of the company, balance sheet, and etc. We will understand that later in the video. Number two, principle of safety refers to risk management so you can avoid severe loss and take calculated risk. Third, and the most important, adequate gains and not extraordinary, because we are here to invest and not speculate and gamble. You have to set clear expectations before getting into the market. You cannot turn 10,000 into a million. That is just unrealistic expectations and will demotivate you. That can happen, but only professionals can do that. You and I, who are teenagers and someone in their 20s, and we want safe returns, we want to build a passive income for our retirement, we have to go for safe asset classes. And we can also take risk, but calculated risk. We do not want to gamble. And taking risk really comes down to your own personality. What is your risk appetite? You have to understand yourself, therefore you can understand your risk appetite. Now let's dive into how to invest and the breakdown of investing. One pro tip before you start to invest in various asset classes is that you have to set an emergency fund, that is 3x or 5x of your monthly expenses stacked up in a different bank account. For example, it really depends on you. For example, if I spend 10,000 a month, I have to set 50,000 in a different bank account. Now this is an emergency fund and it will really help you at times of emergency. This is really essential before you start investing in the markets. Now let's understand how you can invest in gold just while using your screen. First, let's hop onto the chart of gold using 3 months time frame. In this chart, you'll see that there is a steady rise in this chart, you will see that there is a steady rise in the value of gold from 1976 to 2023. You might see a correction in 2012 to 2016 period. Well, that was because central banks stopped buying gold, which decreased the demand and hence decreasing the price. That rarely happens. The dollar was very strong at that point of time, so I'll still classify gold as a safe haven and a very safe, reliable asset. Now let's understand how you can buy it. Now let's understand, if you invested 1000 rupees monthly starting from 2019 to November 12, 2023, or like November 26, 2023, which is a period of 5 years. Your expected value of investment was 60,000 and your gain was 26,000, an absolute return of 44% and your compounding annual growth rate of 15.16%. So this is a very good tool to hedge against inflation and you will gradually increase your wealth with this safe and reliable asset. I really suggest you to put 15% in gold. So I just had a haircut. Now let's dive into the second asset class, equity shares and the indexes. Let it be US, let it be India, that does not matter. I'll teach you what are the three parameters to look for before investing in a company, and this is strongly for long term purposes and not for short term gains. And what are the market conditions you have to care about before investing in a company. Now, as I told you, ROE refers to net income upon shareholders' equity. If company is making $100,000 and providing a return of $10,000 for every $100,000 invested, that is 10% ROE. I told you 5 years average ROE should be 20% for a safe investment. And here are the fundamentals of Tesla and no, sorry, Nvidia. And if you go to ROE, you see the last 5 years are 25, 29, 43, 18, 70. That's well above 20%. Now, according to the method of ROE, this company gets a check as the ROE is higher than 20% for the last 5 years. But before investing, we have to look at more things, but it gets a check in ROE. Now, if you have equity shares of the company, you are a part owner of that company. That makes you eligible to get a percentage gain out of profit of the company. Dividends are one of the best ways to analyze a company's stock or a share price, because you cannot fake profits and you cannot manipulate profits, whereas 90% books of accounts can be manipulated. But profits are real, and if you have profits, you have to give dividends. You have to give dividends, and 90% of books of accounts can be made lucrative to attract investors, but you cannot fake profits and give fake dividends, because dividends is real money. Now you must be thinking, a lot of companies do not give dividends and believe in investing and reinvesting for the growth of that company. I know when the companies are reinvesting for the growth of the company, you have to see for the retained earnings of the company. If now when it comes to retained earning, you have to see if the company's retained earning are gradually increasing, and even if they are not increasing, at least they are stable. And when it comes to dividends, you have to see if they are actually gradually increasing, and even if they are not increasing, you have to see if the company is providing you with stable dividends from last 5 years, and that is a positive indicator. This shows a lot about company, because as I told you, you cannot manipulate profits. So, the third thing you have to look before investing into a share or a stock is shareholding pattern. You have to know who are the investors or the participants in that stock, because you have to make sure promoter is not selling off his holdings, which means if promoter sells off his holding, it means the company is loss making and he does not believe in his own company. Promoter is the founder of that company. So you have to make sure promoter is holding or buying more shares, because that will indicate a positive sign for potential growth of that company. Second, you have to make sure FIIs are at least 10%, because FII are smart money. They know more than us, they know more technical, they know more fundamentals. So if they are investing in a company, it's basically for a reason. They see a potential in that company. FII and DI involvement, and the promoter is not selling of his shares. Third, pledged share. There should be less pledged share. Pledged share means that putting your shares as a collateral to take loan. The less pledged share, the more potential for growth of that company. You have to make sure the company you're investing is the percentage of promoters pledged share are as less as it can be. So you have to understand this. There should be FII involvement, DII involvement. There should be no promoter selling, and there should be buying or holding of promoter, and there should be least pledged share. There should be no loan via using shares. So I know what you're thinking. I know what you're thinking. You're thinking that I don't have a risk appetite. How will I invest? Well, mutual funds are the way. Mutual funds are developed by asset management companies, which works under a fund manager, which who invests your money and provides you with a viable and a safe return. The best mutual fund is ICICI Prudential Nifty 50 Index Direct Plan Growth, because always invest in index growth. Because imagine, so if you want to invest in mutual funds, invest in ICICI Prudential Nifty 50 Index Direct Plan Growth. This is where I invest. You can invest in any, but make sure it's Nifty 50 fund, because you are betting on Reliance, Infosys, Axis Bank, HDFC Bank, ICICI Bank, TCS. You are investing on these blue chip companies, and India will grow, so your money will also grow. Make sure you invest in these funds, because India is a developing economy, so you have to make sure you diversify your portfolio into Indian mutual funds, into Nifty 50 Index Mutual Fund. As I said, I want to balance my equity portfolio as well as my mutual fund portfolio. So I also invest in ICICI Prudential US Blue Chip Equity Direct Plan Growth. Now, this is a mutual fund which invests in various US based companies. You can also do the same, because again, US is a developed nation. So if you want to have the balance in your portfolio, you should invest equity US India and mutual fund US India. Well, it's your choice completely, but this is what I prefer. I prefer to invest in Nifty 50 as a US blue chip equity fund. I personally do not invest in any other mutual funds. I just like these two mutual funds, because I want to go for a long bet. I want to go for a long period of time and keep my money compound. So personally don't invest in more than two mutual funds, because I'm in this game for a long period of time and I want the eighth wonder compounding to show its effect. I want the compounding to show the magic and multiply my money. So I'm in this game long term, and I am willing to diversify my portfolio in various asset classes. That is it for this video. I want to tell you, if you want to become a better investor, you have to thoroughly introspect yourself and understand your own risk appetite. You have to understand yourself. Do you want to take that risk on the new crypto, or you want to play stable? You have to understand your own risk appetite. It's therefore, for this video, that is it. I told you how to invest in equity and gold and mutual funds. If you have any queries, feel free to comment down below and DM me with any questions.